Hello, this is Chuck Arnold, and I'm the Chuck in the Markets Up Chuck. Still suffering with a little laryngitis, so bear with me. But this week's blog has been dedicated to the importance of earnings, and today's blog was titled Earnings Rule. And the reality of it is whether earnings go up, down, or sideways, in the long run, stock prices are going to follow earnings. So I thought I'd show you some examples that I think really clearly validate this principle. Let's start with Tyson Foods. As you can see here, this company's earnings have been all over the place. Up, down, up, down, up, down, down, up, down, up. And as you can see, the stock price has pretty much tracked that. And if you look at this company, this over a 20-year period as a long-term investment with a 2.7% earnings growth, shareholders ended up earning about 1% a year and did far worse than the market. So obviously it was the earnings here and not the stock market that drove returns for Tyson. You can contrast that with a company like Hormel, which has had a very consistent, not very fast, about 8.5% growth rate. But I want you to notice the green line is earnings per share. And look how the stock price, followed earnings. The short-term volatility, as I mentioned in the written part of the blog, is always going to be the price are going to go up and down. But anytime they get disconnected from earnings, as I've pointed out over and over again, they always come back to earnings. They got overvalued here in 09. They got undervalued in, November of 08. And now you can see the price is coming back. We end up with an 8.5% growth rate here. And we end up with, a little undervaluation, about 7.5% return. Obviously, a little better than the market, but consistent with their earnings growth. I'm going to kind of stick with food companies or companies, that basically you'll recognize in this week's blog, just to give you some insights here. Look at Sara Lee. Look how good their earnings were in the first, 15 or so years of this chart. And as you can see, the stock price got disconnected from earnings, but it inevitably comes back to earnings. But you can also see the stock price eventually tracked earnings. But then with Sara Lee since, 2004 has had some very poor operating performance. And you can see their stock price has fallen from a high of $25 down to $6.80 before recovering back to $11.56. But ultimately, the point is it's the earnings that rule. Now let's take a look at a couple of beverage companies. Here's Cott. You can see a lot of volatility in their stock price, after they went public, back in 1992. But then, of course, earnings didn't justify this price, so the price eventually came back down to earnings. Then they had a couple of bad years of earnings. You can see the stock price, over that period of time collapsed. Then they kind of got their mojo back, and their earnings growth was real good again. And you can see stock price follow that. And then, of course, more recently, their earnings have collapsed again. The stock price has fallen from an overvalued $33.67, got all the way down to 59 cents before recovering back to $8.36 on October 29th. So basically, the bottom line to all this is the importance of earnings cannot be overstated. Stock prices can go wacky at any point in time in the short run, but inevitably they're going to follow and track earnings. You contrast Cott to PepsiCo, you can see that Pepsi's had very consistent growth. There have been times because of the quality of this company, the market price has overpriced the company, but inevitably, the stock prices track earnings, and when they get disconnected from earnings, they always come back to earnings. So, the earnings rule was the title of today's blog, and the bottom line is in the long run, it's earnings that really matter. Smart investors should understand that it's easier to forecast within reasonable degrees of accuracy how well a company's business is performing, and put your faith in that rather than a schizophrenic stock market where prices can bounce around all over the place. This is Chuck Armos. I hope you enjoyed today's blog, and I'll talk to you again tomorrow.